Welcome to the Passive Mobile Home Park Investing Podcast with your host, Andrew Keel. This is the podcast where you can get the education you need to invest 100% passively in the highly profitable niche of mobile home parks.
Welcome to the Passive Mobile Home Park Investing Podcast. This is your host, Andrew Keel, and today we have an amazing guest in Mr. Ben Braband from Saddleback Valley Communities. Before we dive in, I want to ask you a real quick favor. Would you mind please taking an extra 30 seconds to head over to iTunes and rate this podcast with 5 stars? This helps us get more listeners, and it means the absolute world to me. So thanks for making my day with that 5-star review of the show. All right, let's dive in. Ben's current portfolio consists of 46 mobile home parks across 9 states, which is approximately 5,200 mobile home park lots and over 1,000 park-owned homes. Ben is a past president and current board member of the Rocky Mountain Manufactured Housing Association. And prior to the real estate space, Ben was an LA police officer and a Naval Intelligence Specialist. Ben, we are excited to welcome you to the show.
Thanks, Andrew. Good to be with you.
Awesome. Would you mind starting out by telling our listeners your story and how in the world you went from being an LA police officer to getting into manufactured housing communities?
Sure. Well, it was a kind of a windy path. It wasn't a straight line by any means, but I had a passion for real estate at a pretty young age, going back to like literally junior high and high school. But I knew that I wanted to get married. I got married fairly young at 19 and wanted to have a family. The only thing I knew about real estate was an uncle who was either driving the coolest car or trying to borrow money from my parents who didn't have any money. So even though I was very passionate about real estate at a young age, I didn't pursue it. And I went with what I thought was a more conventional path, something more stable. So I ended up in the military and in law enforcement. But even while I was on probation with LAPD, I was looking at real estate and ended up participating in a program called Officer Next Door, where I got to buy a HUD home at 50% off. And so from that point on, even while I was a young police officer, I was starting to do flip homes. So I did a lot of fix and flips. I actually did some spec home building and got introduced to manufactured housing through that process, where I was basically buying lots. And instead of stick building spec homes, I started using multi-section manufactured homes. And that led me to get a dealer's license in like 2002 or 2003. So we were pit setting double wides and then building site-built garages. So they looked like, and we even stucco wrapped them. So they looked very much like a traditional stick-built home. They were priced similarly and did that for a number of years. And that's kind of the introduction to manufactured housing. But that's kind of a don't kill, don't eat business. And so I was looking for more passive and or recurring income. And that's how I ended up making my way into the park business.
Wow. What a fantastic story. And so was all of this on the side while you were police officer, just kind of doing this, all the fix and flips in addition?
Yeah. So, I finally made the move out of law enforcement and into this by getting my real estate license. So I was literally a retail real estate agent and doing all my real estate activity on the side. So I had about a 3-year period where I was sort of full-time real estate, but I was a real estate agent earning commissions. And I used those commissions kind of chunk money to buy some rentals, but a lot of flips and some of the land that I bought and ultimately developed, and later duplexes and triplexes and apartment buildings, 20, 30 unit apartment buildings and things like that. So, yeah.
Wow. That's fantastic. Would you mind telling us about your first mobile home park that you
Sure.
bought? How'd you get educated on the space and how that deal came together?
Yeah. So I actually had done a fix and flip in a mobile home park that was a big lesson for me, because even though it was profitable, there was a ton of aspects or things about that deal that I didn't understand in terms of the dynamics of a mobile home park. So I had been looking for a park for probably a year and a half before I ultimately purchased the first one. And I was doing the classic looking in my backyard and looking at deals that I could afford, which was not a lot. But ultimately, I went one state away. My first park I purchased in 2005 in New Mexico. It was a 42 space park. I bought it for 450 grand. I put down 200,000 and the seller carried 250, and made about every classic mistake you could imagine, mostly due diligence, things like electrical infrastructure, sewer lines. But mostly the mistake was around the assumptions that it would take to fill those roughly 20 vacant lots. The capital need, is very capital intensive. It took about twice as long as I thought. Ultimately, it was a big success story. Made a ton of money on the park and held it for quite a long time. But that was my first one, and certainly learned a lot from that one. Yeah.
Oh, wow. That is
So
fantastic. And where are you based at now?
I'm actually in San Diego. Most of the portfolio, well, the concentration with most of our back office and our team is in Colorado. I lived there for about 7 years before moving here. And so most of the organization is still based out of Colorado, and I still have my ranch in Colorado as well. So the plan was going back and forth between San Diego and Colorado, but I don't get back to Colorado as much as I'd like. So
Very cool. Well,
yeah.
that is awesome. What do you think is the toughest hurdle to overcome in mobile home park investing?
I consider this business really simple and straightforward, but at the same time, it's not easy. And I think a lot of people don't understand the nuances. So I think there's a lot of assuming that turns out to be more complicated because the concept is super simple, right? You own the dirt, you rent the space, people own their home, and in the traditional sense, it's a pretty straightforward. I mean, the only thing perhaps more straightforward would be a parking lot. But that all that said, the day-to-day operations and the nuances within the industry are a lot more complicated. Financing, regulation, misunderstanding with a lot of local governments. So I think those types of things become challenges that surprise people. And particularly if they look at like my first park, it's 40 spaces, there's 20 vacant. I'm going to plug in 5 homes a year, and the park's going to be worth so much more. And the journey from filling that park, which I ultimately did, took literally twice as long, probably twice as much money, and all kinds of things came up along the way that I just had no understanding of, even having owned apartments and things like that prior to. So I think it's just the learning curve. It's totally achievable, and certainly don't want to dissuade anyone. I think it's one of the best things you could get into. But you just have to persevere. You have to kind of get educated and learn from as many people as you can prior to taking those lumps yourself. And then when you take them, you've got to take them in stride and learn that lesson, and then don't repeat the mistake. So
Totally. Yeah.
yeah.
And how did you get educated? Did you go to like the Frank and Dave boot camp? Was that around
Yeah, it
back
wasn't
then?
around at the time. Actually, at the time that I got involved, I was there when Frank and Dave met. So yeah, there used to be Steve Case and Corey Donaldson used to host Mobile Home Millions events.
Hmm.
So they had one in Anaheim, I think it was in '05 or '06. There was one in Austin a year or two later, and they were pretty large events, similar to maybe to like Seco now, little different bent, and a lot of the folks had there wasn't a lot of education happening at the time. Lonnie Scruggs had his Deals on Wheels, and things like that were out, but there wasn't a ton of education going on at the time. But that was the group that was providing some education, and they hosted similar boot camps to Frank and Dave's today, where you'd meet at a park and you'd walk with the owner of the park, and kind of a 2-day intensive. And so I did participate in those. In fact, all over the country. I went to Georgia and Texas and Oklahoma and all over. And I basically, I guess that's one thing. I was never afraid to invest in the education. So I would fly anywhere. I'd pay the $300 or $500 to attend, or even a couple thousand. I did a lot of that on a regular basis. And I don't regret one dime of it or 1 minute that I spent doing it. So
Totally. Yeah.
yeah.
No, same here. I've been to the boot camp 4 times
Yeah.
and I don't regret it at all. I've learned something new every single time I've gone,
Yeah.
and the networking at those events is fantastic as well. So
Phenomenal.
highly recommend that. I want to circle back. You mentioned Lonnie Scruggs. So
Yeah.
I'm not sure if you're familiar with my story, but that's how I started, was a Lonnie
Oh,
dealer
is that right?
and around Central Florida. And I just found Lonnie on YouTube, talking about deals on wheels.
Yeah.
And that was like the only education I could find online back, when I started, which was like 2015, 2016. So
Okay.
that's fantastic. When
I,
did you buy that first park, the one in New Mexico?
That was 2005. Yeah, that was
2005.
2005. So that
Wow.
was my first park, and I bought two others within 12 months of that first one. So I had a 3 park portfolio kind of within a mile radius of one another, which was, I guess it was about 180 sites collectively. And then we had about 100 apartment units in the same town. So we put
Wow.
together a 300 unit sort of portfolio between the parks and the apartments in that market.
That is so cool. I really wish I was getting into the spot in
Yeah.
2005. Maybe I would have waited until like 2008, to jump in. But
Yeah.
maybe what can you tell us about owning mobile home parks during the Great Recession, 2008 through 2010, and how did the parks perform and that kind of stuff?
Yeah, so I was really fortunate. I kind of cut my teeth on those first few parks in say '05, '06. So when '08 hit, unfortunately I had a ton of friends in real estate in general that really took some hits. And I actually was able to make my biggest stride. I went from 300 units to about 1,100 units in 2008, 2009. And it was because of a large acquisition that I wouldn't have otherwise even had a shot at. I mean, the seller wouldn't even have spoken to me, given my size and lack of experience, but there was nobody else at the table. So the things I could tell you about sort of operating during economic hard times is, one, opportunities are likely to present that you may not have otherwise seen. Two, one of the biggest challenges is credit constraint. And that was certainly the case at the time. Lenders were afraid to do anything. Sellers, there's price discovery to the downside throughout the entire journey. And that lasted several years. I was able to make a couple of big acquisitions between '08 and say 2012. And those were great moments. And in terms of the park performance, we actually saw a significant increase in demand. We already had good demand, but at the time, the big story was unfortunately lots of foreclosures and people losing homes. And part of the dovetail into our park-owned home strategy is we're able to attract a lot of those folks who are being dislocated and offer home ownership, but also offer rental options in the interim. And so, I think the takeaways were, be prepared, be liquid. There's a good chance there's a lot of opportunity in those moments, but you're going to have challenges that you may not otherwise have seen over the last 5 years, primarily regarding your capital stack. So that was my experience at the time, and that's what I'd anticipate. Should we encounter that again in the future.
That is fantastic. Love to hear it. Maybe tell us a little bit about what that portfolio looks like now. Like, where are most of your parks? What does a typical park look like,
Sure.
size wise, et cetera?
So we still have a big presence in Colorado. It's kind of our biggest initial acquisition. We bought 750 units in one deal in Colorado, and since then have added several additional parks. We've also moved into Arizona pretty aggressively, and then also Wyoming and Utah. And I had a pretty big presence in Kansas. However, it's my first sort of disposition in nearly 20 years. So I don't own anything in Kansas anymore. But we've also operated in Missouri and Oklahoma. I've a portfolio up in Maine of about a dozen parks. So, but basically, sort of that western, Colorado, Arizona, Utah. That's kind of our sweet spot. And in terms of individual deals, I prefer to buy portfolios where possible. And the big strategy for me is getting a foothold somewhere and planting a flag that's large enough to support the way that we operate, and then bolting on around it. So I really like clustering and concentration. I don't like the shotgun approach. So we're not the group that's going to buy every deal that hits the market. If we don't already have, infrastructure in that market, it has to be a large enough deal to move into it and also compelling enough. And these days, we're really just building out around where we have higher comfort and have, infrastructure. So
Very good strategy. And what does that perfect mobile home park look like for
yeah,
you
sure.
guys?
So the last park I just bought this past month or in August here is only a 52 space park. So we're not exclusive to a 200 space park, but the perfect park I suppose would be 150 to 200 sites, public utilities, not a ton of common areas or amenities, strangely enough. But the other thing that's sort of probably a response that you don't hear a lot is we're really looking at whether the strength of the community itself. So I think it's a intangible that people kind of miss is, if it's a tight knit, close knit community, they tend to do, really well, and you can build on that. Beyond that, we're really looking at the market. So, supply demand is a big one. People talk a lot about median income and diverse employment and things like that. And those are all super critical in terms of our criteria. But in terms of the park specifically, we've done really well with 150 to 200 space parks, particularly if we can, have three or four of them in a market.
Totally.
That's kind of what we've done. Yeah.
Tell me about that. You said the tight knit community. That's something that you look for. Like, what does that look like?
Yeah, so we've had some communities that were great. Physically everything was great. Public utilities, nicely amenitized, good condition, sort of in terms of the infrastructure, but it was really difficult in some instances to get resident buy-in. And we believe in sort of a philosophy of kind of we put our foot forward first in terms of cleaning up communities. We don't come in and We never have come in and raised rent just right on acquisition. We really come in and try to understand the market, where we fit within the marketplace in terms of the offering that we have in comparison to the competitors. And then, if it needs improvement or there's deferred things, we address that. Then we look at our street rents and market rents. But, in some cases, we've done all of those things and we still don't get the reaction and the response from the community. It's almost like there's some kind of ingrained bitterness. And I can't say that this has happened to us a ton, but I mention it because when the opposite occurs and you move into a community that's, that neighbors look out for each other, they're looking for win-win situations with management and ownership. Those are just so much more fun. It's not that the others can't be profitable, but you're swimming upstream the whole time. And winning hearts and minds takes a lot more time than people realize. It takes the right on-site folks on our team. It takes us doing a lot of outreach in terms of, backpacks back to school and barbecues in the park and movie night. And, I really emphasize that because I think it's really critical going forward that what we're offering is not just shade and shelter. We're trying to build strong communities that are going to withstand, the tough times and frankly help look out for the neighbors and for our asset as well. And that's just something you don't hear discussed enough in my view, but it's really a big differentiator between a strong asset and one that just sort of is profitable.
That is fantastic. And I mean, we've had several operators on here, and I don't think anybody has mentioned that dynamic, which is
Yeah.
really, really cool. Is there something you guys do in due diligence to try to tell if the community is going to be one of those tight knit communities or if it's going to be, more of an isolated type of community?
It's really challenging because it is an intangible and therefore, any sort of metric or quantifiable data is hard to come by. So it's really what I consider kind of the guerrilla part of due diligence, where you're walking the park, you're talking to the folks, you're understanding, it's easy to read Google reviews or easy to read, some of the naysayers. And some of that is to be expected. You're going to encounter it virtually everywhere. It's easy to believe when you're buying a deal that the previous ownership or management was just bad. And sometimes that's the case, but a lot of times, they're not as bad as they may be made out to be. Doesn't mean that we're not going to try to do better in every instance, but I guess the answer to your question is we do all those things. We read reviews, but the big thing that we do different is we'll talk to as many of the existing residents as we possibly can face to face during our multi-day due diligence on site. And that's tricky too, right? Because the manager, the owner, a lot of times they're trying to steer you away from those conversations,
Yeah.
particularly if the reviews and the property's not the way that it should be. But and you also, I would say, you have to take those with a grain of salt too, because you're going to find people who are just looking
Yeah.
to set you up for don't raise rent or leave us alone. But really, when you find the more genuine, authentic folks who are just trying to get through life and live in a respectable community, they shine through. And so listening to that and having your ears open for that, I think is really all you can do in terms of that.
That's huge. Yeah. No, I couldn't agree more. Yeah. That's your customer. That's
Right.
that's who
100%.
is you need to make sure is going to be someone that you want around. So
You're right.
that's huge.
Yeah.
Very cool. Thanks for sharing that. I want to
Sure.
circle back. So do you do syndications, like one-off syndications, or do you have like a fund model?
No, I've never really raised outside money. So we've kind of recycled equity and I kind of had a small stable. I still do, a handful of LPs. So our structure is really, really simplistic. It's me as the sponsor, GP, and operator. And then I have literally a handful of folks that we collectively have been growing together for 25 years in real estate. Some of these folks were with me at my fix and flip single family home stage.
Wow.
And what we've done is, as I moved into this space, they let me kind of get my toe wet a little bit and figure some things out. And then they followed me in. And so the difference, though, the reason I've been able to do that and grow the portfolio to its size is some of these folks, were high net worth people, they're family offices. So I've not gone out and raised funds. I haven't done private placement memorandums. They're generally me and one partner or me and 3 to 5 people. And they're generally all repeat kind of LPs. So it's a
That's
very simple
fantastic. Wow.
structure. And we also have paced ourselves around that strategy. So I've had opportunities, many instances for institutional capital partners, or I've watched a lot of my peers raise a ton of money and really scale and grow dramatically faster. And I'll be honest, I for a brief moment regretted, given the increase in value and everything, that maybe I should have done that. But at the end of the day, I'm a simple guy. I have more than I need, and I really like the simplicity of our structure. I'm not really
Yeah.
beholden to anybody. I'm take my responsibility to my LPs and my capital incredibly seriously, but I'm happy to have grown over a slow period, what I consider to be responsibly and safely. And I don't lose sleep overnight that I'm going to lose any money, or any of my partners will. So,
That's awesome.
but that's how
Yeah.
we've worked over the last couple decades. So,
No, thank you for sharing that. I
yeah.
mean, almost 20 years you've been in the space. That is absolutely fantastic. There's not many people that have been on the show that have been in the business that long. I think
Yeah.
there's been an influx of people, around 2015 or so that kind of
Right.
came into the business,
Yeah.
but you were ahead of the game 10 years, sooner.
Yeah.
So I would love to know, we always hear about like what deals looked like back then.
Yeah.
Was it every deal was a 10 or 11 cap, when you first started looking?
No, well, and honestly, maybe, an 8 or 9 was probably today's 5 or 6, realistically. But the same things happened there. You had the juggernauts of the day were ARC. Today you've got RHP and ELS and Sun, and a lot of these folks, and a lot of them do a phenomenal job, but their equivalents existed at that time as well. So what a lot of us had that were starting out was secondary and tertiary smaller deals that didn't interest the bigger folks. No doubt you have more consolidation today, and certainly a lot more participants and entrants. The difference, though, is the capital. So back then, your available debt was dramatically different. Today Fannie, Freddie are kind of the biggest. They have the biggest share, and CMBS was just a few years before that and still have a decent share. But back then it was a lot more local and regional banks. Fannie, Freddie would really, and insurance companies would really only do what they consider to be 5-star type top flight stuff. And we always looked for the value add stuff, the stuff that was, the way I would describe it is it had more value creation potential. They would describe it as hairier or unstable or distressed. And so the debt and available capital for stuff like that was dramatically different than it is today. And so while cap rates were higher, so was the cost of the capital, and or lower LTVs, and just a little bit more conservative underwrite. So I think that was some of the big differences. The competition level and the stuff we've seen, sort of the euphoria over the last few years, certainly didn't exist from '08 to 2012, but it ramped from 12 to 15, and went, like you said, 15, 16, things really got juiced up. And from then until probably 8, 10 months ago, we were just on a crazy upward trajectory. And personally, I've seen a bit of a cool off, but not enough to call a change in direction, but certainly a change in pace or sentiment from at least 15 to, say, 22. So
Totally. Yeah. Same with us. There's
yeah,
still sellers. How do
yeah.
you buy most of your deals? Are they mainly listed deals?
Yeah, the first big deal that I mentioned, strangely, well, so the first deal I bought off of LoopNet,
Wow.
direct seller, listed as Park, and that was my first deal. The other two I kind of found word of mouth. So when you're in a market, you kind of go meet your quote unquote competitors, and we kind of just put the buzz out that we're in town, we're looking to grow, and funny enough, our manager talks to their manager, and the next thing you know, we're talking to the owner. So we've done that a fair amount, but really lately it's been broker relationships and or word of mouth. That big deal I bought, I actually found it in the LA Times. And it's funny because I still find and buy deals occasionally that are listed on the MLS. Somehow, some way, they're not listed with a big broker. They may not even be on Mobile Home Park Store or one of these other places. So, there's still a little bit
Yeah.
of, turning over the rocks, but generally speaking, our deal flow is pretty conventional. Sometimes we get a call before it hits the market or before the OM is published. And those are, relationships with brokers that we've cultivated for a long time. And they know that we don't tie deals up. If we put it under contract, we have every intent and ability to close. Once or twice we haven't, but everybody involved understood why. But generally, we don't kick tires, and we're not just sending LOIs. We don't cold call. But again, we're fairly opportunistic. We have pretty tight criteria in terms of geography. And, we like to buy a few deals a year, or, we end up with kind of a fits and starts where we'll buy, 5 parks, and then 2 years later, we buy 3 more. And we'll have literally a 2-year gap in between. And usually what we're buying in between is kind of bolt-ons. So things within the market that we're adding on. And that's also a bandwidth issue. One of the lessons I learned early on is, particularly if you're trying to do a lot of value add, especially occupancy upside or infill parks, it takes a lot more time and energy and resources than people might imagine. So I've seen people come in and buy a whole bunch of stuff, and they were probably strong acquisitions, but then they're unable to execute and they end up struggling, and they end up with debt maturity concerns, or just stuff that they're really not comfortable with their own pace and progress. So we've kind of learned those lessons the hard way. And not to say that we pass an opportunity, but we kind of gate our growth around our ability to digest it and do a good job executing on it.
That's huge. Yeah, no, and that goes back, like I was at MHI in Vegas, and there was institutional capital guy that approached and said, "Hey, I want to write you a check for, $50 million to buy up a bunch of mobile home parks." And I said the same thing. I was like, that doesn't sound
Yeah.
feasible, especially
Yeah.
right now. And
Yeah.
and I think it's a personnel thing. I mean, I don't know about you,
Yeah.
but we manage in-house, and
Yeah.
like to be able to trust all the people that you would need to onboard to be able to scale that quickly it's just too much stress that I wasn't ready for. But do you guys manage in-house, Brad?
Yeah, yeah. So we have
Nice.
a management company that's sort of a sister entity, if you will, that I own and operate. And so everything that I buy, I manage, and at the same time, I don't do any fee-based management. So if I don't have an ownership stake, I don't manage for others. So that's how we operate. And I would echo exactly what you said. The last 2 years in particular has been incredibly challenging with labor and talent and building our team. And even prior to that, the time that it takes to get a good maintenance tech, or a home tech in our case, or a community manager up to speed, I think it's a 6-month minimum journey. And really it's a couple of years before they're good at their job, what I consider
Totally.
good at their job. So, scaling is challenging. It's exciting, but, the people are one of the biggest challenges, attracting and retaining the right type of talent. And without them, I think if somebody was a coupon type guy, yield guy that was looking to, really just get a 7-8% yield on their money, that's one thing. But if you're looking to buy deals with a lot of upside, and particularly infill projects, or frankly anything with deferred maintenance, I think people dramatically underestimate the timeline and the resources required to turn those around. So,
Totally.
for us, you can't pile too many of them together, or you start to fail.
Yeah. Let's talk about the park-owned homes, because
Yeah,
I'm not an advocate of
yeah,
park-owned homes. I think
yeah,
it has a lot to do with the markets that we're in, which are
yeah,
mainly secondary, tertiary markets throughout the Midwest.
yeah,
And, other markets, people are able to rent park-owned homes for $1,500 a month.
yeah.
But I mean, tell us about your strategy with park-owned homes, and, why you guys have chosen to go that way.
So the strategy really came out of necessity, frankly. Our portfolio in Maine, we bring in maybe 20 new homes a year, and we don't keep any of them as rentals. That it's
Mm.
to your point, each market is unique, and we're able to sell those homes, at cost, or a very small margin, and we can do it at a pace that makes sense. The reason that I say we've kind of embraced the park owned home model, and it was done out of necessity, is we'll buy 750 spaces that have 350 vacant lots. And
Oh,
if you
wow.
just really extrapolate out a sales model, and let's say you have 5-year money, and you've got a sales model exclusively. If you are doing a phenomenal job, and I'm not to say that this can't be done better, but 4 homes a month, that's a lot. 50 homes a year
Yeah.
is a pretty strong pace. But if you think about that, and then look at your underlying debt, especially if you assume that the first 6 months you got to get your house in order, get your team put together, you've got to get a dealer's license in the state, you've got to get your funding available. 6 to 12 months, you're not bringing in new homes. You're likely dealing with existing inventory and abandoned homes and things like that. So you're really starting this process at your end of year one. And then if you say, okay, even that pretty wild 4 home per month absorption rate, you're going to fill 200 vacant lots. And I would say that's twice as much too aggressive. In other words, 2 a month is probably more accurate. Of course, market dependent. Of course, depends on price of the home and the other, inventory in that market. But my point is, we had to fill a lot of lots quickly, in order to be able to take out our acquisition debt. And we typically use pretty creative funding to close some of these deals that are considered distressed or not, not eligible for Fannie or Freddie or even CMBS money. And so we have a clear goal in terms of occupancy. And one of the only ways to accomplish that was through a faster absorption rate, which in our case, in most of our markets, has proven to be rentals. And initially, I'll say we started with a lease with a purchase option, not a rent to own. There's a distinction, but nonetheless, we were attempting in the early years to mirror ownership. We really wanted to be the traditional, we're going to own the lot, so you're going to own the home. But that presented some challenges that we discovered later in that process. And nonetheless, the exclusive sales model was just not going to be fast enough. And so, over the last 15 years, we've learned a ton of lessons, and we operate our home entities profitably. It requires more personnel. It's a higher touch business. It's more effort. It's not a high margin business, but we look at it holistically. So if we're creating $40,000 to $60,000 in value every time we take a vacant lot and make it performing, we're okay with the additional effort that it takes for a relatively small return to get there. And what I'd say too is these are phases for us. There's like an iteration or life cycle of the deal. So ultimately, we'll sell off the sort of bottom 10 or 20% of the home portfolio, and we'll work towards your more traditional park. However, for us, that could be a 10 or even 20-year journey. And in the meantime, we're going from 50% occupancy to 90+%, and we're doing it profitably. And we're doing it at the pace that the market will absorb. So, if
patient,
it's
slow and steady,
yeah. Mm-hmm.
which I think is totally realistic, that the market, like we're finding we have one property where we have 15 vacant homes right now that we brought in, rehabbed, got them ready to go. But the absorption is we sell maybe one or two a month.
Yeah.
And it's just taken longer. It's not like, you're going to be able to sell all those in a single month. Just the market, there's not that many people looking for housing. So that's
I think the other big piece too is, if you look at it as all equity. So let's say a single wide, of course, they used to buy them for 22,000 for 1676. Today it's more like 65, 70,000. But the point is, if you're using all equity and you are buying park owned homes as opposed to buying more parks and real estate, I think that it's going to break down pretty quickly, the strategy. You're not going to want to put your equity into the homes. However, if you're using leverage, and in our case, that's roughly 80%. So we have maybe a 20% downstroke into the home piece, which we also usually recycle that through, various refis and things like that. You end up with actually a reasonable rate of return on your 20%. And it's accretive to the overall value creation of the whole deal. And so for us, that's how we look at it. As a standalone business, would I go buy park-owned homes in someone else's park? Never. That's not my business model, and I wouldn't advocate it. And frankly, I wouldn't advocate the strategy for anybody who's not comfortable with it. But for us, the way that we capitalize that effort and the way that we recycle our equity and improve the debt on the park-owned homes over, say a 5 or 10-year period, it has worked really well for us. And honestly, I don't know how we would have done it in some of these markets otherwise.
Yeah.
So,
and I mean, I think you said you had 5,000 lots and like 1,000 park owned homes.
yeah.
So, 1,000 park owned homes kind of gives me a little heartburn right away. But then it's like, oh, well, that's only 20% of your portfolio. So
Right.
you still have a lot of tenant owned homes as well. But that's fantastic. I appreciate you sharing that with us.
Sure.
And yeah, really interesting. So has your mobile home park investing strategy changed at all through your years in the business, compared to like your first park obviously was like a big value add. Are you still looking for those type of projects?
I still like the value add because in terms of acquisition criteria, everybody seems to have a hurdle in terms of rate of return. But the thing that I personally look at primarily is equity growth multiple. So I'm more interested in my coverage ratio and having debt that I can sleep with at night. But going forward, I'm looking for deals that I can create a lot of value, whether that's increasing rents, whether it's submetering utilities, whether it's being more efficient with expenses. But more often than not, the deals that seem to line up for me are big infill or vacancy play issues, in addition to those other things, those other levers. So we tend to have focused on that type of stuff. And I guess what I would say is in the past, I was, it's easy to fly anywhere in the country. So in the past, I'd fly to Alabama, and I'm, from California, or I'd go to Illinois. And what I've learned is that there's nothing wrong with that. But for me personally, in terms of changes, it's not so much the deal criteria itself in terms of the physical park or the return requirements. It's really more around, even though we're very comfortable operating at a distance, we really have, want to stick with this concentration strategy. But where I've seen people have problems is, and we've experienced it ourselves, we have one park, even if it's 80 to 100 spaces, being able to have that park operate at, 40, 45% OPEX ratio and have the right on-site folks and throw enough profit and value creation potential is tough. And especially if you go down to a 40 or 50 space park, like even if it's a phenomenal like 11 cap acquisition and it's great deal, they're hard to pass. And in the past, I wouldn't pass up on those. And today I do. And it's really funny because early on, I had a limited partner who was kind of a higher net worth guy. And I was a small time guy. I didn't have any money at all when I started. And I would take him deals where I was like, we're going to make 50 grand on this in 4 months, single family flip type thing. And he wouldn't do it. And I had a track record of doing it. Like it was super predictable. Of course, there's risk in anything, but in my mind, like this is a slam dunk. And he would tell me no. And I'd get so frustrated because I'm like, man, I don't know why you don't see this. Well, what I've learned over the last couple decades is something can be a great deal for somebody. It doesn't necessarily mean it's a great deal for you. And it's not because it's not going to produce a great return. But for me, my time is more valuable to me than making an extra $1,200 a month. And I don't mean that in any kind of slight. $1,200 means a lot to me. However, I'd rather move into deals where I can create millions of dollars or tens of millions. And more importantly, I'd rather do it within my personal sort of life balance where I've got folks who I've worked with for a decade who are going to execute for me. I don't have to go out and try to solve a problem on one lot in a 40 space park, an 8-hour flight away. So that's a change. And I wouldn't have said that even probably 12 years ago. I guess as you get older, you you evolve, and that's one of the ways I've changed in terms of criteria. Yeah.
Yeah. No, thank you for sharing that.
Yeah.
What do you think about like secondary, tertiary markets versus like primary markets at this stage in your
Yeah,
career?
it's really funny. I mean, I've focused on those primarily my whole career. And it was again almost out of necessity. When I'd go into those big core markets and big MSAs, they were kind of crowded out. And I made my way into a few of them. And what I found actually is that I didn't enjoy the experience as much. And the reason why is because we've had the most success. And again, this is referencing vacancy upside. In some of those larger markets, there's a lot more supply. Not only is there more competition, so you're getting bid down in terms of cap rates and you're paying more, but in addition to that, you have more supply or more potential new supply that comes into the market. Most of the secondary and tertiary markets that we move into, there's one common denominator, and that's supply constraint. So as long as you have diverse economic drivers and you have a supply demand imbalance, that's actually what my preference is. I would rather go into a 60,000 population market than a 2 million population market in most cases. And the underlying reason, if I had to articulate one factor, it's the supply demand imbalance. And if I was buying a park that was full and I was really just looking at long-term market rent upside, then I probably would have a different perspective. But the predictable, attainable value creation for us has come in secondary and tertiary markets that are somewhat ignored or excluded from larger operators' criteria. We get a better going in price, and we also can get market share. So we can kind of dominate and or dictate street rents in a way. We prefer to draft behind one of the bigger guys, let them be the bad guy, and we still have a competitive advantage drafting a little behind them. But nonetheless, having market share, we're in a market with 1,300 spaces and we own 900 of them in one case. And it's not a bad position. So that's kind of part of the strategy that we've kind of learned along the way and kind of embrace.
Awesome. Yeah. Thank you for sharing that, Ben. It seems like you guys are very strategic, and I like that. I consider your model very similar to ours. It's
Okay.
like there's very easy upside here. There's vacant
Right.
lots, fill the 20 vacant lots and you're going to add tremendous amount of value for every
Yeah.
dollar you spend. You're typically doubling it. So
Yeah.
that's really awesome. And I love that you're fighting for the secondary and tertiary markets as well, because there's more mom and pop owners typically I've found in those markets. And you can, we got all of our deals have been bought off market through cold calling, and that's where we're able to find the better deals. Ben, what mistakes have you made in mobile home park investing that you think our listeners could learn from?
I mean, better question is what mistakes haven't I made? Going back to the first park, missing a ton of stuff on due diligence. I mean, that's the classic response, and it's a good one because you don't know what you don't know, and anything substructure can bite you, and it tends to be expensive. But the thing that I would say that I think is actually probably more powerful for people to understand is, bad assumptions. So, we usually did a pretty good job even early on in terms of assessing the market. And our due diligence was weak in the beginning. So we've made a ton of mistakes there and learned a lot. But the thing that actually hurt more than that was bad assumptions regarding how capital intensive things were and how long it would take. So, typically in the early days, we were wrong by 100%. If we thought it was going to be 300 grand, it was 6. And if we thought it was a 2-year journey, it was probably 4 or 5. And the reason I point that out is because that kind of thing can lead to big problems with your capital. It can put you in a bad spot with your debt, and worse, if you've created expectations for your LPs around your budget or your pro forma or your execution, that's a tough spot to be in. And thankfully, when I learned those lessons, I had one partner who was very understanding. We were along the journey together. He knew that, it was a learning curve, and neither of us enjoyed being wrong in that way, but we kind of owned them together, even though I was the operator and ultimately the one who made the mistake. But trying to get tighter on those assumptions and avoid the urge to assume that you can do so much better than sort of industry standard, I think is a pretty valuable lesson to learn as early as you can in your career. And it was a big one for me.
That's great advice. Yeah. And back to the due diligence piece, because I've made mistakes as well. I always say, like, at the MHU boot camp, you get this 30-day due diligence handbook as like a starter point, but there's so many things like the big important stuff I've learned from trial and error, just by doing and learning and finding out things that have changed. And now, I think it started at 50 bullet points was like our initial due diligence checklist. Now it's like over 300 bullet points long, because we've just learned something on every deal to make an extra phone call or check an extra item. So I'm sure you've done the same.
100%. And sometimes it's stuff that you've never encountered. You've done 100 parks or 80 parks or whatever, and there's still something new that comes up in some municipality that it wasn't in any of the books and you didn't encounter it before. But, being able to handle those kind of blows and figure out solutions, kind of persevere through that, that's the differentiator between folks who kind of wash out and people who figure it out and ultimately are successful. But they're tough. They're tough to work through in the moment.
Oh yeah.
Yeah,
Definitely. Definitely.
Yeah.
Ben, I just have 2 more questions for you.
Sure.
What would you say are the most important things that passive investors need to look out for when investing into mobile home parks?
They really need to understand, in my view, their deal sponsor and the GP. They, track record, referrals, history is really important. I also think that a lot of people don't understand what they're signing. As crazy as that sounds, as an LP, you're going to see a lot of documents, maybe a PPM, maybe a operating agreement. These things seem boilerplate. They seem like legalese, but I've seen a lot of people get twisted up with one another over just different expectations. And, sometimes it's not even fraud or in the extreme cases, that's what happens. But in a lot of cases, it's really just a misalignment of understanding. And so for me, if I was putting my money alongside someone passively, I'd really want to know who that person is, their track record, what their focus is going to be, because a lot of groups, raise a lot of money and they go and buy a lot of deals. And it's really, really difficult to maintain focus across that, especially when you're growing so quickly. So nothing taken away, nothing from any of those folks. Some of them do a phenomenal job and they're really safe, probably investments for folks. But if I was putting myself in those shoes, I'd dig in more and take personal responsibility. Even though I'm going to be passive on the front end, I would put in a lot more effort than I see a lot of people do to understand what I'm getting involved in. And I think it's a big mistake for those who don't. Yeah.
Yeah. And is there anything specifically that you would do to try to vet that operator? Like,
Yeah, I mean, I think track record is a big deal, but it's hard because some of the folks don't have a ton of experience, and I didn't either. And I don't think I was a bad bet. However, if somebody's criteria would have been, we want to see that you've done this 20 times, they wouldn't have put their money with me. So, I'm not trying to be critical of anybody, but I think the track record probably is the thing that you could lean on the most. And what I'd look for too is not just all their wins, but what happened when you encountered the tougher stuff.
Mm.
Because, in '08, I had a ton of friends who tossed keys back to banks. And it was kind of a common practice. I never did. I had probably my worst real estate deal I ever did was 5 single family homes, brand new homes in Gulf Shores, Alabama. I didn't know anything about the market, but I had a bunch of money that I needed to put to work, and it was called the Go Zone at the time, the Gulf Opportunity Zone. So the mistake I made there is I leaned more into the tax advantage and less into my diligence in the market and the deal itself, and it burned me. And I probably had a $4,000 or $5,000 a month negative carry on something that started out being a $4,000 or $5,000 a month positive carry. And I only highlight that because it wasn't okay for me to turn the keys back into the bank when it got tough. And the reason is because, well, first of all, it's against the way that I think about things, but not being a Pollyanna that happens in the big boy world of investing. I didn't do it because my reputation and my ability to borrow going forward would have been forever hurt. So I think that if I was looking at track record, I'm not just looking for everybody's wins and show me, your 14 or 16% IRR. Show me the deals that didn't work out and how'd you manage it? How'd you minimize losses? How did you work through it? How'd you turn it into a win? I don't think that's a common question. And I don't think you can show me an operator anywhere that has any kind of track record that hasn't hit a rough spot. Not necessarily a loss, but something that could have been, or something that was a surprise. And how did you manage it?
Yeah, that's great advice, Ben. Thank you so much for that.
Sure.
Last question. Where do you see
Yeah.
the future of mobile home park investing going? Like, obviously, interest rates are pretty high right now. There's possible recession talks. What do you think?
I'm very bullish on the industry in general. I think that sometimes we're our own worst enemy and we shoot ourselves in the foot with headlines of crazy rent increases and stuff like that. At the same time, there's a ton of deals out there that are way under market and they need to come up in order to remain viable. So there's a balance between, that comment. But generally speaking, I think the business is phenomenal space to be in. Even today, I buy a park today, I bought one this month. So I still would be a big advocate for people looking at it, the opportunity. I do think it's going to get harder to do what we do, primarily because of government intervention. We're in a tough spot because some of the folks that we're dealing with have limited resources, and there's more and more pressure put on those. And it seems as though the public sector kind of looks to us on the private sector to kind of solve some of those societal issues. And I think that they're going to continue to look at things like rent control and all sorts of other stuff that's going to make our life, frankly, more challenging to do what we do. But that said, I think there's going to continue to be demand. I think that there's no other form of detached housing that can compete with us. I think we're a huge solution to an even bigger problem. And so, and I think there's a lot of headroom in a lot of places, especially some of these secondary markets. So you can still offer a incredibly compelling value proposition to the consumer while still making a tremendous amount of money. So, and I think that looking at it from each of those participants' angles is key to doing it successfully long term. Think of it from the consumer's perspective as well as ownership. And if you do that, there's a lot of reason to be really excited about the business in my mind.
Totally agree with you. Ben, thank you so much for coming on the show.
Yeah, absolutely. It's a pleasure. A lot of fun.
Awesome.
So,
if anyone of the listeners would like to get a hold of you, what would be the best way for them to do so?
probably email. I'm on LinkedIn. You can find me there, but also just ben@saddlebackpro.com. That's my email. So, we don't sell anything or offer any services, and we really don't even take outside money, but love talking about the business. So if I can help anyone, I'm happy to do that. So.
Yeah. Awesome. Well, thanks again, Ben. Really appreciate it.
Yeah.
That's it for today, folks. Thank you so much for tuning in. Would you like to see mobile home park value add projects in progress? If so, follow us on Instagram @PassiveMHPInvesting for photos and awesome videos from our recent mobile home park acquisitions. Once again, that's @PassiveMHPInvesting on Instagram. See you there.